Welcome back to Options Trading for Beginners. Today, we're going to dive into a concept that's absolutely crucial for managing your risk and understanding how your options positions will behave. We're talking about the Greeks. The Greeks are a set of metrics, each represented by a Greek letter, that help us measure the sensitivity of an option's price to changes in different factors. They give you a real-time read on how your option's value is likely to change with every shift in the market. They provide a standardized way to measure the risk and reward of a position, beyond just looking at the options premium. You can find the Greeks on any options chain, typically displayed as a column of data for each individual options contract. Remember, a single stock does not have a single value for any of the Greeks. Each Greek is specific to each individual option contract and can vary by both strike price and expiration date. There are 4 primary Greeks every options trader should understand: Delta, Gamma, Theta and Vega. Let's break each one down. First up, Delta. Delta measures the sensitivity of an option's price to a $1 change in the underlying stock price. For example, if a stock is trading at $100 and a call option has a delta of 0.5 and the stock moves to $101, you'd expect the option's premium to increase by 50 cents. As a standard US equity options contract represents 100 shares, a delta of 0.5 would mean your position's value would change by $50. This is a key metric to understand your exposure to the stock's price movement. Delta is not just a measure of price sensitivity, it's also a rough approximation of the probability that an option will expire in the money. At the money option, where the strike price is equal to the current stock price, will typically have a delta very close to 0.5, reflecting a roughly 50% chance ending up in the money. Options that are deep in the money, meaning they have a significant amount of intrinsic value, will have a delta close to 1. This is because they behave much like the stock itself. As the stock price moves up, their prices move almost dollar to dollar with it. On the other hand, options that are far out of the money, with no intrinsic value, will have a delta close to 0. This tells you that for a small price movement in the stock, the option's value won't change very much. It's the large price movements that are required to make these options profitable. Key difference between call and put options is their delta range. Call option deltas range from 0 to 1. The higher the delta, the more the call option's price will move in line with the stock. Put option deltas range from 0 to -1. The negative value reflects the inverse relationship between the stock price and the put option's value. As the stock price goes up, the value of a put option goes down. For example, put with a delta of -0.5 means that if the stock price goes up by $1, option's value is expected to decrease by 50 cents. Understanding delta is also crucial for position sizing and hedging. For example, if you own 100 shares of a stock and want to hedge your position with a put option, a put with a delta of -1 would perfectly offset the price movement of your 100 shares. If the stock goes down by $1, your shares lose $100, but the put option's value would increase by $100. This is a form of delta hedging, and it's a critical concept for risk management. Brings us to Gamma. Gamma is a second-order Greek that measures the rate of change of an option's delta. In simpler terms, it tells you how much your delta will change for every $1 move in the stock. High gamma means a small move in the stock can cause a large accelerated change in your delta, leading to rapid gains or losses. Gamma is highest for at-the-money options and for options with a short time until expiration. This is because their value is most sensitive to immediate price movements. As the stock price moves, the gamma of an at-the-money option will cause its delta to increase or decrease rapidly, magnifying the impact of the price movement. For options that are deep in the money or far out of the money, gamma is very low. This is why the delta is more stable and closer to 1 or 0 respectively. Understanding gamma is crucial because it helps you gauge the volatility of your delta itself. For example, imagine a stock trading at $50. An at-the-money call option has a delta of 0.5 and gamma of 0.1. If the stock moves up by $1 to 51, your delta will not just stay at 0.5, it will increase by the gamma of 0.1, becoming 0.6. Now for the next $1 move in the stock, the option's value will change by 60 cents, not 50. This acceleration of delta is why gamma is so important, especially for those who are holding options contracts that are at the money. Then we have Theta. Theta measures the rate at which an option's value declines over time due to the passage of time. This is the core of what we call time decay. Every day it melts a little more, and Theta tells you how fast that melting is happening. As an option gets closer to its expiration date, its time value erodes, and Theta shows you exactly how much premium you're losing each day. For option buyers, Theta is a constant headwind. It's the cost of holding the option. For option sellers, however, Theta is a huge advantage. They are collecting this daily decay. It's important to note that this decay is not linear. Time decay accelerates as the expiration date approaches, meaning Theta is at its highest in the final weeks before expiration. A call option with 90 days to expiration might have a Theta of negative 0.05, losing 5 cents a day. The same option with only 10 days to expiration could have a Theta of negative 0.2, losing 20 cents a day. This acceleration of decay is why many option buyers get burned by holding positions for too long, while option sellers make a large portion of their profits in the final weeks of a trade. Theta is a key part of many income generating strategies, such as selling covered calls or cash secured puts, which we'll cover later in this series. Finally, Vega. Vega measures an option sensitivity to changes in implied volatility. For every 1% increase in implied volatility, Vega tells you how much the option's premium will increase. For example, if an option has a Vega of 0.2, a 1% rise in implied volatility will cause its premium to increase by 20 cents. The higher the Vega, the more sensitive the option's price is to changes in implied volatility. Vega is highest for at-the-money options and for those with a longer time until expiration. This is because these contracts have more time for volatility to affect their value. Understanding Vega is crucial because it helps you quantify the risk you're taking on volatility itself. When you buy an option, you are typically taking a positive Vega position. This means your option's value will increase if implied volatility rises and decrease if it falls. When you sell an option, you are typically taking a negative Vega position. This means your option's value will increase if implied volatility falls and decrease if it rises. Understanding the Greeks is not about predicting the future, it's about understanding the mechanics of your trade. Delta is about direction and probability. Gamma is about the acceleration of your gains or losses. Theta is about the passage of time and its cost, and Vega is about your exposure to changes in an option's price due to changes in implied volatility. By mastering these four metrics, you'll gain a deeper understanding of your positions and be better equipped to manage risk and make informed decisions. Don't forget to like and subscribe so you don't miss the rest of the series. Thanks for watching.